let's talk about trading SPX, ES, and SPIs together, for example. This question has been asked by many clients. How do you create a vol curve that describes all these products together? My usual answer is that you actually don't want to fit them all together. And the reason for this is that when you create a vol curve, when you fit option prices, you would like to recover the vol curve that other market makers are using, basically some combined curve. And that allows you to create short-term valuation, what I call short-term valuation, the price that you should be using deciding where to place orders. If you place an order, a bid or ask at that price, and the probability of a fill is the same, whether it's a bid or ask, then I would call it short-term fair value. And if you fit it to SPX and ES at the same time, and they don't agree, then you're going to have bias both to SPX and to ES markets. And then what are you going to do with this? In principle, there are some short-term supply imbalances in such markets, depending on which players are buying or selling at this particular time period. And if your valuation is crossing or biased relative to prevailing market, what are you going to do with this? So instead of doing that, I suggest to fit both markets separately and then use the basis between them as a signal for your position targeting. And when you fit with Vola dynamics, you're not just getting the vol parameters, you're also getting the parameter error bars. And that allows you to judge how far the disagreement between two vols is relative to the bid-ask spreads, like in vol space. If you throw in SPIs, the situation is more complicated because of two problems. One is that SPY is not really, it doesn't really hold S&P. It holds a replicating basket of S&P and some cash component, all the dividends that have been paid before they redistribute. When you have cash dividends on SPY, you also need to figure out which dividend model you use. This means what's your definition of volatility in the presence of cash dividends. And the last complication is American options that don't expire exactly at 9:30 or 4 p.m. As SPX options or ES options. So you need to take into account the expert mismatch. You can use time converters to do this, or you can put some upper and lower bounds on the variance that can accrue between SPX and SPY effective expiry, and use that as a signal how far those volatility curves can go relative to each other. When you do such research, why Vola dynamics makes it easy is because the filter is super fast. It's not sensitive to all kind of things temporarily, microstructure noise and other problems that usually can happen when the market moves and when you have real noise in the data, and that you have output error bars, a very simple interface to compare volatilities at different levels, either work with vol parameters or sample volatilities at different levels. If you want to compare vols at the money or at D2 equal to 0 or variance swap levels, this is all very easy to do, just one function call. One more thing I'll add here, that when people talk about mean reversion trading, there are usually two flavors of this. One is I would call in price space. It's when you compare the levels. And the example we just discussed, is really about the level. Is you basically saying that we know that ES future settles exactly into the same print into which SPX options settle, and the vols have to be exactly the same. You may need to take some settlements and margin differences, but up to those delta 1 corrections in option prices in volatility space, they're really the same thing. You know, if that's 20 vol, then the other one also has to be 20 vol at that particular strike level. So you're comparing one level against another level. If they're off, then you can put a trade between them. And a different way of trading is when you are creating your signals in return space. And an example of that would be comparing vols at two expiries, for example. So there's no fixed relationship that if one level should be this, then the other level should be this. But over time, they've been reverting. So you are if say 1 month vol moved and the 2 month vol didn't, then eventually you would expect the 2 month vol also to move with some square root of time ratio, but nevertheless, there should be some lead lag relationship or something like this. So you don't know exactly the price level at which they should be, but you know that the returns should be correlated. Many co-integrated strategies, in general, like in vol trading, this is a paradise for anybody who wants to do any kind of co-integration or mean reversion trading. You have literally thousands of parameters if you consider all the expiries, all the vol levels, Q levels across different names and correlations, and they're all mean reverting and co-integrated. Okay, happy trading.